All right, family, let's keep it 100% real. This week was an absolute battlefield on Wall Street. If you've been tracking the broader markets the last two trading days, you already know a massive wave of volatility hit the tech and growth sectors. My portfolio took a substantial hit, down over $14,100 in just 7 days. That is a 5.45% drop on paper. For a lot of retail investors, watching five figures evaporate in a single week is enough to trigger absolute panic and emotional selling. But when you build a portfolio correctly, near-term volatility does not faze you for a second. So, what actually caused the market to drop so hard out of nowhere? It was a perfect storm of macroeconomic data hitting all at once. First, a massive May jobs report dropped showing the economy added 172,000 new jobs. That completely doubled Wall Street's expectations. While a booming job market sounds great, it sparked a major interest rate scare. Traders instantly realized inflation might stay sticky, and the bond market rapidly priced in a 70% chance that the Federal Reserve might actually hike interest rates later this year instead of cutting them. At the exact same time, the high-flying semiconductor sector took a massive reality check. Broadcom reported solid earnings but left their long-term artificial intelligence guidance unchanged. Because market expectations are so hyper-aggressive right now, institutional funds used it as an excuse to lock in profits, causing tech giants to temporarily tumble. But look, the market moves in cycles. When big funds rotate capital out of expensive growth sectors, it doesn't mean they are leaving the market. They are moving into defensive, value-driven assets. And that is exactly how I manage this turbulence. This portfolio isn't built on hype or a couple of lucky picks. It's a highly intentional hybrid machine holding 82 distinct positions with a structural baseline dividend yield of 5.86%. During the market pullback this week, I was actively optimizing. I rotated my capital completely out of Pennant Park and moved it straight into Main Street Capital. At the same time, I deployed an extra $2,000 cash into Ares Capital to lock in more stable defensive private credit income while the sector was on sale. That is how I play defense while keeping my wealth building engine running. While equity prices were tumbling on paper, the income side of this portfolio was operating at peak efficiency. Let me show you the absolute transparency of how this cash cleared throughout the week. We kicked off Monday, June 1st with Pennant Park paying $10.36, Visa chipping in a baseline $1.84, and Enbridge hitting the account with $15.40, though we did see a minor $2.31 adjustment on that one. We also had a $19.17 distribution from STRC. On Tuesday, June 2nd, the Defiance S&P 500 Fund, SPYT, delivered a triple payout, $13.09, $11.43, and $10.20. Wednesday, June 3rd was a massive midweek scaling point. Round Hill's TSPY dropped a clean $53.64. Then JP Morgan's JEPQ hit us with a double tranche of $58.70 and $6.21, while JEPI landed a triple tranche of $13.24, $9.73, and 16 cents. On Thursday, June 4th, yield Max's YMAG hit the account with its double tranche of $47.95 and $10.95, alongside iShares BALI, which brought in $34.42. And finally, to close out the week on Friday, June 5th, Round Hill's QDTE added $20.36. Defiance's QQQY gave us a double tranche of $6.99 and $4.12, and Goldman Sachs's income funds absolutely dominated, with GPIX dropping $27.93 and $10.11, and GPIQ printing a beautiful $49.53. When you add up all 14 moving parts across all covered call strategies, business development companies, and dividend equities, We pulled in exactly $433.22 in pure cash flow during a down market. Wall Street can adjust my net worth on paper all day long, but they cannot stop these distributions from clearing. That cash gives me immediate stress-free liquidity to buy the macro dip at a massive discount without ever touching my principal. Let's zoom out for the ultimate reality check. Today, this portfolio sits at over $245,300. But back in July 2020, this exact account started at precisely $0. No massive seed capital, no head start, just mechanical, relentless consistency through every market correction, interest rate scare, and volatile cycle we faced over the last 6 years. So when a macro pullback wipes out $14,000 on paper in a week, I don't sweat it. Years ago, a red week like this would have ruined my entire month. Today, the portfolio structures pay me hundreds of dollars to just sit back, relax, and wait for the recovery. Stay disciplined, trust your structure, and focus on the cash flow. Hit that subscribe button. Let me know in the comments how your portfolio handled this week's macro storm, and let's keep building together. I'll see you on the next one.